JB!
Derek, nice to see you.
Nice to see you, nice to see you. And where are we today?
Well, this time, Derek, we're actually in Trondheim, Norway.
We're nowhere near Trondheim, Norway, JB. Where are we today?
Well, we're back here on the River Clyde, overlooking the Scottish Exhibition Centre.
We are actually looking over the Scottish Exhibition Centre, affectionately known as the Armadillo, and this is the River Clyde, which is the 8th longest river in the UK and the 2nd longest in Scotland.
There you go. Armadillos. Steely on the outside, empty on the inside.
I hope there's no inference there, JB. Anyway, enough of this. Should we talk investment?
Let's talk investment.
Great. Speak soon.
Welcome to another DB Meets JB. My name is Derek Borthwick, I'm a minor communications specialist, and I combine the latest findings from neuroscience to help companies and individuals with their pitching, presenting, public speaking, sales skills and strategies. And I'm on a mission to improve the communication process between buyer and seller. And I'm delighted to be joined today by a good buddy, JB Beckett. How are you today, JB?
I must like it here because I'm back again, Derek.
You are back again, I know. I think we've kind of moved in here, haven't we?
It's quite nice, actually.
It's quite nice, yeah. Well, today, JB, I'd like to talk about a very topical area, and that's the absolute return space. Mm-hmm. And I guess we should probably start off defining what do we actually mean by absolute return. What's your understanding of an absolute return fund or strategy?
It's interesting because it became such a vogue term right in the last few years, and I think people think that absolute return is a new invention. The reality is that absolute return goes back to 1946, would you believe, in the US. And it was used ostensibly by US hedge funds and US institutional investors. So what is absolute return? In its simplest sense, it conveys that rather than trying to beat a benchmark or competitors or a peer group, that you try to generate positive return, ideally as often as possible, and ostensibly through a whole market cycle. So whatever that market cycle does, whether it goes up, whether it goes down, whether it goes sideways, an absolute return fund is aimed principally and marketed and sold as such to deliver you a positive value. And quite often that will be a positive value that at least beats cash, because more often than not, cash can give you a positive return in any market cycle. But cash plus maybe 1% per annum, 2% per annum, 3% per annum, or 4% per annum. But of course, people think that absolute return is actually something new, and it's not. It's been around for a long, long time. What's changed is that absolute return first jumped across the pond from the United States into Europe and has moved from the institutional market into the wholesale and retail market. And so absolute return, it's about delivering positive returns. It's not necessarily about chasing a benchmark.
Yeah, so we're looking at essentially trying to get positive returns here, irrespective of market conditions. Now, does that mean all absolute return funds are the same then, JB?
If they were, I suspect many of the problems and malaise that we see in the industry today, as noted in the FCA asset management study, probably wouldn't have happened. The reality is, it is a completely non-homogeneous group of strategies. And I used to sit on the IFAMA, which is a European trade body, on their European Fund Classification Forum. And so I was part of the group that originally set down what absolute return should look like for Europe. And this was in the mid-2000s. And we came to the conclusion then that we couldn't actually typify an absolute return fund. Because absolute return is not an asset class, it is an intention, almost a promise, albeit they're not guaranteed returns, but it's a type of strategy that tries to deliver that positive return. And so we have absolute return funds today that are effectively equity-based, long-short, which basically means that the fund manager is both buying the equity market and selling against the equity market. Absolute return bond funds, clues in the name, they're using basically bond strategies, but using some hedging techniques around them. Multi-asset funds, and what we might call diversified growth funds. And we've talked about multi-asset in another session.
We have, yeah.
But just to make the point that absolute return, you can't typify to one particular asset class, you can't typify it to one particular strategy. And so you have to look at all these very differently.
Yeah, you do. You do, JB. You're absolutely right. There's a huge variety out there. And with that in mind, they have had a lot of criticism, and you've touched on that already. What are the main problems that you see in the absolute return space? And is there anything to be done that could perhaps alleviate those problems?
So if we break down when we might expect absolute return to do well, and then conversely when it won't do well. So absolute return strategies look fantastic in falling markets.
Yeah.
So absolute return funds became incredibly popular after 2008.
Yeah.
Ironically, the highest sales flows into absolute return funds occurred in 2009 and 2012.
It's always the way.
Probably the most pronounced bull market in history.
Yeah.
And I called this the uncertainty premium. It was like a hangover. Investors felt incredibly battered by the great financial crisis and therefore wanted to try and dial out some of that uncertainty about where it was going. Don't forget that whilst that 2009 and 2010 were very aggressive bull markets, we were still at a point where we thought that financial markets could completely collapse. We didn't feel like we were out of the woods. And so investors were lured into buying them increasingly. So I think that's part of the issue that we've seen with absolute return funds. And I've forgotten where my flow of thought was.
We were talking about the criticisms.
The
and
criticism,
how they could
yes.
actually be.
So we'll cut there. So the criticisms that are then levied against absolute return funds are that in bull and momentum markets, they don't do very well. Well, they're not expected to do very well. So there's a bit of misreporting, I think, in the media about that. But even when we've seen the introduction of volatility and some fall-offs in the equity market, absolute return funds still haven't done very well. So something's not quite working there. So the criticism is they just don't perform very well. They've been net erosive to capital once you take into account charges. Charges have been another criticism of absolute return funds, that they've been charged far too expensively. And then if we look inside those strategies, we can see that many of the sophisticated trading, sophisticated idea generation and strategies have just underperformed. And why is that? Did the strategies suddenly become too clever for their own good? Did they think they suddenly believed their own hype that they could outperform the rest of the market? It's partly true. In reality, many of these strategies are run very prudently by very competent fund manager teams.
Yeah.
We've seen too many funds proliferate into the market, and that's a massive issue. That you now have the good, the bad, and the ugly in the absolute return space. 10 years ago, there was only a handful, much easier to both research and select them. Now there are a lot more. But also many of the underlying presumptions of what makes absolute return strategies work, particularly in the multi-asset space, is one, diversification effect. There's a general textbook rule that if you diversify your portfolio, that you can smooth out the individual volatility of the different assets to generate a more consistent return. The nature of the markets in the last couple of years have made that incredibly challenging. And if we look over the last year, very few asset classes actually was able to outperform 3-month dollar-denominated LIBOR, which is the interbank lending rate. So that's obviously going to be very challenging for multi-assets. So they're facing performance criticisms against a very challenging macro environment that is seeing asset classes underperforming at the same time, but actually they should be out of sync. So the diversification that they're expecting isn't happening. And again, that just ramps up the criticism that they've been receiving.
You know,